Welcome everyone. My name is Robert Paxton and I'm the VP of Strategy and Performance for Charles Taylor in Canada. Firstly, I'd like to thank everyone for attending our trade credit webinar today. It's part of our new educational series, and we'll be hosting many more webinars with you over the next year, so please look out for email invitations for the next sessions. I'd like to first cover some housekeeping items before introducing the presenters and the agenda for the webinar. Please note that this session is being recorded, and we'll send all attendees a follow-up email after the presentation with a link to the recorded session. After this webinar, a short survey will pop up. It should only take you about 2 minutes, so we'd be very grateful for your feedback. Just so that you're aware, all attendees are muted. However, we do encourage you to share your questions, and you can do that by entering them into the questions section of the drop-down menu. Regarding continuing education credits, this presentation is approved for CE credits for adjusters, brokers, and examiners. And at the end of the presentation, we'll provide an email address to request your credits. We do ask in the email that you send that you include your CIPR or REBO number when requesting your certificates. We've also included the bios of our speakers in the drop-down, so you can download them for your reference. Regarding the presentation itself, we're excited to share with you today. It's a collaboration between our Canadian, UK, and US teams. And as always, we hope that sharing perspectives from different geographic regions will be helpful for you. CTA has a great deal of global expertise with offices in over 30 countries, and we'll be continuing to share our global expertise and local knowledge with you in our upcoming webinars. So today we have 5 presenters for you. Roxy Thornhill, Mike Holley, Zuhaib Saif, Simon Cook, and Ed Brittenham. I'll introduce each of the presenters in more detail before their individual sections of the presentation. So before we move on to the agenda, we're going to kick off today's session with a quick poll. So the question is, you should see it in a second. Over the past 12 months, where has Charles Taylor Adjusting seen more credit and political risk claims from? A, COVID-19 related claims, B, fraud, C, trade sanctions against Russia and China, and D, Brexit. So we'll give everybody a few seconds here to answer. And let's pull up the results. Okay, so there's a good mix there, but the majority was right. It's fraud. So you're going to hear a lot more about fraud in the presentation today. So for the agenda, the webinar will start with an overview of why fraud is such an important issue for underwriters and claims examiners in the credit and political risk market. We'll then move on to how you can detect fraud in advance by covering examples of recent fraud cases that hit the credit and political risk market and introducing ways that these might have been detected at the underwriting stage. We'll then discuss detecting fraud from a forensic examination of accounts and the telltale signs which were present in our case study examples. We'll then move on to look at the behavior of the directors through analysis of their social media profiles. And we'll also discuss detecting fraud at the claim stage. Finally, as always, we'll have 10 minutes to answer any questions you'd like to ask. So now I'd like to introduce our first presenter, Roxy Thornhill. Roxy is an associate director at Charles Taylor who is based in London. She's over 15 years claims handling experience in trade credit claims, and her areas of expertise are property and casualty, trade credit, and political risk. So Roxy, I'll now hand over to you to start the presentation. Thank you.
Thank you, Robert. Similar to our experience detailed in the poll, within the political risk and trade credit market, everyone we speak to tells us that the most significant claims activity in the past year has arisen due to fraud at the buyer or obligor. At Charles Taylor, we get to see a large number of these fraud cases from various underwriters. This prompted us to consider the cases in detail. We wanted to determine what they have in common and also to see if there were any signs visible in advance, perhaps at the underwriting stage, that could have helped underwriters avoid these risks. In today's seminar, we will present the outcomes of our research into these fraud cases and I hope you will find our insights useful. To kick off, perhaps I should explain how fraud typically occurs in the context of the credit and political risk market. The type of fraud we're discussing here is corporate fraud, meaning the fraudsters are people who are usually directors of a company, and they use the company as a vehicle for fraud, usually to enrich themselves. In our market, whilst fraud does occur, it's typically not committed by the policyholder itself, but rather the policyholder unknowingly trades with the fraudulent company. The policyholder will perhaps unwittingly provide its goods or services on credit terms to a fraudulent buyer. Or the policyholder could be a bank that's perhaps made a loan to a fraudulent entity. Often, the frauds encountered in our industry run to millions or even billions of dollars and can impact more than one underwriter. You may wonder why the fraud is not uncovered at the underwriting stage. We think this is because the normal credit scoring models used by the market often fail to pick up the fraud. Fraudulent companies are very skillful at manipulating their accounts. Perhaps they're even using fictional figures, and as such, they then obtain good credit scores in the traditional risk models. As a result, underwriters may therefore assess the risks as good quality and write large lines. Consequently, the losses can be large and very much out of the blue. In our search to discover how we might spot corporate fraud in advance, we have given a lot of thought to corporate governance standards. Best practice in corporate governance has come a long way over the past 40 years in response to various corporate scandals. The current reference standard for corporate governance are the 2015 G20 OECD Principles of Corporate Governance. These principles make it clear that a director must act at all times in the best interests of the company and not in his or her own private interests. The director must acknowledge at all times that the company is a different legal person from themselves. The company should also be governed by a diverse board of directors with power shared by the group, and no single strong person should have excessive control. There should also be no confusion in any director's mind between the identity of the company on one hand and him or herself on the other. The director is there to serve the company, not the other way around. Clearly, any company which is being used by its directors as a vehicle for fraud is not following the G20 OECD Principles of Corporate Governance, so the question arises, how can we assess the corporate governance and corporate culture of a company? These days, most company directors leave a substantial trail of data behind them, often in social media. Along with our fraud team, we have undertaken careful analysis of the recent cases and believe there is a way to assess corporate governance and company culture by looking at the social media of the CEO and CFO of the obligor. It is now quite well established that there is a correlation between the lifestyle and behaviour of the directors of companies and corporate governance, which in turn is correlated to the risk of fraud. We are looking for signs that the directors are acting in their own interests and not the interests of their companies. For example, are they spending company money in a way which boosts their own ego and status, but does not actually benefit the company? The lifestyle signs that we consider to be red flags are, does the director own expensive vehicles, cars, boats, planes? Perhaps they even have private number plates. Does the director host expensive parties in unusual locations? Are they being photographed with famous politicians? Do they make large and very public donations to charities? Perhaps the director funds movies or famous musicians. Often the features can be seen at the company level too. Does the company have a showy head office in both its fit out and interior? Perhaps the company has a corporate jet or company yacht, with the fit out of either costing more than the vehicle itself. There may be a fountain in the lobby, a fish tank in the boardroom, or perhaps the company sponsors famous sports teams or motor racing, with the directors being photographed and mixing with the famous personalities from these teams. Of course, these behaviours are not a guaranteed proof of fraud. There'll be company directors who do all of these things and there's no fraud within the company. Also, there may be fraudsters who purposefully live a quiet life and do not seek to draw attention to themselves. Additionally, there will be fraud cases where the company directors themselves are not aware of the fraud being committed. Perhaps it's being done by a junior employee in a far-off subsidiary. Nevertheless, there does appear to be a positive correlation between the behaviour of company directors and fraud. The culture of a business is established by senior management and communicated downward. If an underwriter discovers a red flag at the underwriting stage, this could spur further investigations before the risk is bound. Later on, my colleague Simon Cook will show you how social media can be used to identify suspicious director behaviour. In addition to undertaking a social media check, we have identified that there is some extra diligence that an underwriter can perform on the company accounts in the event that they are alerted to potentially suspicious behaviour. We'll also cover that in our webinar. I'd like to hand you back to Robert, who will introduce our next speaker. Thanks for your time.
Thanks, Roxy. So our second presenter is Mike Holley. Mike is a senior consultant, credit and political risk. He has over 35 years experience in the trade credit and political risk sector. Mike has a specialism in trade and supply chain finance. He was the founder and CEO of Equinox Global Limited and holds a portfolio of non-executive direct positions. So we're excited to have Mike here today, and I'll pass over to you, Mike. Thank you.
Thank you, Robert. So as Roxy was saying, we're talking here about corporate fraud. We're talking about cases where the directors are using their companies as a vehicle to enrich themselves. I don't want you to imagine that the companies that are involved here would typically be very small companies, perhaps in very far away countries like Burkina Faso or somewhere like that. That's not the case. The problems that are arising in the insurance market are caused more typically by large household names, names that everybody would be familiar with. And they're occurring in countries like Canada, the United States, the UK, Germany, Singapore, these types of countries. To give you an example, 3 years ago, the largest construction company in the UK exploded into a scandal of fraud and went insolvent and was liquidated. That company was called Carillion. It was extremely well known, and it was capturing the lion's share of government contracts in the UK for many years. So the UK government as well was fooled by that one. In Germany last year, the big fraud scandal was the company Wirecard. Wirecard was a listed company, and it was seen for some time as the darling of the German stock market. It was growing very fast. Its CEO was quite a personality. Often you would read articles in the financial press about Wirecard, where this company was held up as the virtuous role model that all other German companies should aspire to copy. And yet it was being used as a vehicle for fraud on a massive scale. In Mexico, some years ago, Oceanografia was a scandal where a company exploded into fraud, again causing losses for the market. Oceanografia was also very well known. It was the most significant oil services company in Latin America. Its main customer was the state-owned oil company of Mexico, Pemex, and yet here was fraud happening there. So what we are going to do as we go through the webinar into the later stages, we're going to look at 2 case studies, and I want to introduce those 2 case studies to you now, because these are the companies that we will refer to again later on. So the 2 case studies are Agritrade in Singapore and NMC Health PLC, which is a United Arab Emirates / UK company. So to introduce you to Agritrade, first of all, Agritrade International Pte Limited was a Singaporean-based trader of palm oil and coal, which collapsed in February last year in a fraud scandal. Now, Agritrade was a very well-known company. Its sales were around about $2 billion, and it had a history and a track record going back decades. It had been founded by a charismatic individual called Ng Saif Pek, and he had built up the company over those decades to be a $2 billion giant international trading company. If you'd have looked at the accounts of Agritrade, the financial statements immediately before it exploded, you would have seen that they stated that it had $44 million of debt. But actually, after it collapsed, the real debt turned out to be 1.55 billion. So the $44 million was a fraudulent misstatement in the accounts. So we're talking a fraud here of $1.5 billion, and it's really hard to imagine, this $1.5 billion had been taken outside of the company into somebody's pockets. Is really hard to imagine what you could do with that type of money, but nonetheless, that's what happened, $1.5 billion. And not surprisingly, just before the fraud was exposed, Ingse Peck left the country and, to my knowledge, has not been seen since. So the next case study we want to look at is NMC Health PLC. So this is perhaps an even more spectacular case. NMC Health PLC is the main provider of private hospitals in the United Arab Emirates. And apparently they're really good hospitals. It's the main provider of private healthcare. And this scandal erupted in April 2020, so just as COVID was starting. And because these hospitals were such good quality and so significant, it wasn't possible to liquidate this company. I mean, they were needed for the care of many thousands of COVID patients. So this company still exists, and the hospitals are still operating even though the fraud happened. NMC Health PLC was founded by a gentleman called Dr. Shetty, who came from India to the UAE in the 1970s as a very young man, and he founded a healthcare company and he built it up over decades. At its peak, NMC Health was listed on the London Stock Exchange, and it had a market capitalization of $10 billion, so absolutely huge. Just before the fraud came out, it was given a credit rating by the ratings agency Moody's of Ba1, which is a pretty strong credit rating. If you looked at its accounts stated debt of $2 billion, which is about normal for a company with a $10 billion market capitalization. But when the thing exploded last April, it became clear that the real debt was 6.6 billion, that there was a black hole of 4.6 billion, the accounts had been fraudulently misstated, and that the directors were borrowing this money, not spending the money within the company, but were taking it outside and lining their own pockets somehow. And again, not surprisingly, Dr. Shetty left UAE before the collapse and is apparently now somewhere in India. Now, there are other cases. Those of you who are involved in the current credit and political risk market, you will know of other cases which are brewing where there are fraud allegations. We won't talk about them today, but this is an ongoing problem of very great magnitude. And really, for any insurance company, rating agency, bank, or government that gets involved with these types of company, it really is an enormous way of burning time, management time and costs, as well as the cost of paying a claim. So we really felt that if there was anything that we could do to help people spot these cases in advance, that would be a really big plus. And that's why we're having this webinar now. And we hope that you will find the case studies that we now go through to be useful to you. So thank you, and over to you, Robert, again.
Great, thanks, Mike. So our third presenter is Zuhaib Saif. Zuhaib is an executive general adjuster based in our Toronto office. He's over 15 years experience in the insurance industry, including in the UK, Saudi Arabia, Bahrain, and Pakistan. Zuhaib is a chartered certified accountant, and his areas of expertise are property and casualty, fraud, and business interruption. Over to you, Zuhaib.
Thanks, Robert, and hi, everyone. So let's start with, a simple question. Before a risk is underwritten, can we take any steps to detect fraud by analyzing a business's publish financial statements? The short answer is yes, but it can be a very difficult task. Now, before a detailed forensic investigation of accounts is conducted, the first step is to identify, potential red flags in the financial accounts. That is basically what we will be focused on today. So some of the factors that we can analyze include, firstly, interest rates. Basically, this is calculated by taking the interest paid from the profit and loss statement and dividing it by total debt on the balance sheet. What we are looking for here is, whether the interest rate might be on the higher side, or perhaps if, the debt is underreported. Or there might be a case maybe that, the interest rate was actually high, but it was high because it was taken from foreign unorthodox lenders, which could provide us an indication that the local lenders were maybe suspicious of the business, and that's why they had to go abroad. Next, we should compare receivables and payables. The best way to do this is to calculate the day sales outstanding and days payable outstanding figures. You might know this as DSO and DPO. This gives us a good comparison between the average number of days it takes for businesses to collect payments and pay their bills. Once we have calculated these, we then sense check these against the type of business that we're looking at, and also compare to other businesses in the market. If the numbers don't make much sense, then that could be a possible sign of false invoicing or funding concerns. Next up, we would like to look at how the funds are being used in the business. Here we'll look at the loans that were taken on by the business and whether the amounts borrowed make sense for the business. What we are basically looking for is whether the business has borrowed more money than it can possibly make use of. We should also compare the free cash flow with profit. Now, free cash flow is basically a calculation for the cash available to the business to support its operations and obligations. If the business has a high operating profit but a low or negative free cash flow, then that could possibly be a sign of new debt not being retained in the business, but rather pocketed by fraudsters. Now, there are other factors that should also be looked at, but today we will be focused on these four on the left of this slide, since these were the ones that we found common to both our case studies, which I'm going to be discussing. Now, before we go into the case studies, it is important to mention here that if any potential red flags are identified, that should not automatically be construed as evidence of fraud. There could be a number of reasons for it, and this should rather be used as an opportunity to seek clarification from the business. If, however, the business cannot provide a satisfying clarification, then perhaps further forensic investigation would be warranted. Next slide, please. So for our case studies, we will be looking at two businesses, Agritrade and NMC Health. Mike, in his slides, discussed these briefly as well. Next slide. So just like I mentioned in the previous slide, these basically are the four factors that we are going to be looking at. Now, coming to our first case study, that would be Agritrade. Now, the following slides are based on their financial statements ending June 30th, 2018. For Agritrade, all figures used to make the calculations are on these slides, but we will be focused on our final findings here. So for interest rates, in case of Agritrade, the interest paid was $17 million, which is hard to reconcile to other parts of the account. If the debt was actually 43 million, then it would represent a 40% interest rate. Now, that is simply unrealistic, right? If we add bills payable and trade creditors to the debt, then the interest rate comes to around 10%, which is still very high. What we now know is that the actual debt was $1.55 billion, according to the Singapore High Court, which handled the insolvencies. Next slide. Agritrade had receivables of $187 million, but payables of only $12 million. This effectively gives us a DSO versus DPO comparison of 38 versus 3 days. Now, there is a significant gap between these numbers, which is highly unlikely for a trader. Because for a trader, payables and receivables are usually at similar levels. Agritrade also had $135 million in supply chain financing, which gives us an average of 30 days finance terms. However, we know that the actual supply chain finance was on 90-day terms based on a review of the insurance policy. Agritrade also had inventories of $49 million, which gives us inventory days of only 11 days. Now, average inventory days figures vary by industry, but in 2018, the median for a wholesale trader was around 74 days. As you can see, there is a significant gap between the inventory days of 11 versus the industry average of 74 days. These numbers are hard to reconcile. Next slide. The underwriter was told that the Agritrade had $561 million in short-term working capital finance. Now, we know that this was a lie, as the actual figure was $1.55 billion. The $561 million disclosed could not possibly have been used for working capital financing, as the working capital on the balance sheet was much lower at $161 million. Let's say even if it was all used in supply chain financing, it still does not make sense. It certainly appears that Agritrade was borrowing far more than it could use. Next slide. So if we compare the free cash flow versus profit, we see from the cash flow statement that the operating cash flow was $120 million. Now, after deducting capital expenditure and net interest expense, term loan repayments, we are left with a negative free cash flow of $8.9 million. Now, this negative free cash flow is hard to reconcile with the $95 million profit after tax. Now we will discuss a second case study, which is NMC Health. Our calculations here are based on their financial statements ending December 31st, 2018. So in case of NMC Health, they had an interest rate of 6%. But if we add some transaction costs relating to some refinancing, this figure goes up to 8%. Now, a company with a Moody's rating of BA1 would not be paying this level of interest. It's just quite high. NMC also had receivables of $639 million against payables of $317 million, which effectively gives us a DSO versus DPO comparison of 108 versus 56 days. It is hard to understand why the receivables and DSO would be so high for this business, since the receivables for a healthcare service provider in 2018 averaged around 50 days. So here we're looking at more than double that of industry average. Next slide. According to NMC accounts, they took on $850 million of new debt during 2018, and also incurred 38 million structuring charges in the process. There is no obvious use for all this new debt. We do know that they spent $480 million in acquisitions, but given that their declared net profit was $251 million, it is not clear why this new debt was needed or how it was used. We now know from the insolvency records that borrowed money was being taken outside of the business, and that the actual debt was $4.6 billion higher than the amount stated on the balance sheet. Next slide. So NMC's profit margin as per the financial statement was approximately double that of its peers. Their account showed a net profit of $251 million, whereas the free cash flow is calculated to be negative $91 million. Now, this is a similar situation to Agritrade, like I discussed previously. This negative cash flow is hard to reconcile with the high net profit. Next slide. So NMC had some other red flags as well, which are worth mentioning here. like they overpaid for acquisitions. An example is that they paid $36 million for a company which only had 10 employees. They also overpaid for construction work to a company that was owned by NMC's founder. So in conclusion, through these case studies, I hope that we have been able to show that reviewing financial statements for red flags and asking the right questions at the right time can be really helpful tool for underwriters and could also help in countering fraud down the line. That's the end of my slides. But before I hand it back to Robert, I would just like to mention that those interested in the forensic investigations, they should definitely have a look at the Muddy Waters Research Report on NMC, which is available publicly on their website. It is a fascinating report and a great resource to understand the investigation that is done in identifying potential frauds by reviewing financial statements. Thank you for listening, and back to you, Robert.
Perfect. Thanks, Zuhaib. So our fourth presenter today is Simon Cook. Simon is the head of Specialist Investigation Services at Charles Taylor. He has 23 years experience in the insurance industry, and he set up our multi-award winning Specialist Investigation Services in 2008. Simon is a subject matter expert in counter fraud and international investigations. Over to you, Simon.
Thanks very much for the handover there, Robert. So today I've been asked to give an overview of how social media and open source data analysis and investigations can assist underwriters with your due diligence process. But before I proceed, I believe it's important to mention that all the inquiries I refer to in my short presentation today relate to open source data, which is in the public domain. So in other words, this is information available right now to anyone at this webinar with time at their disposal, utilizing normal internet search engines. We believe that all businesses can become more intelligence-led when it comes to writing new business. And Charles Taylor is now an intelligence-led business, and we are helping our clients to follow suit. So I'd just like to set the scene so that everyone can have an understanding of the value of conducting social media and open source intelligence checks, which will help you in your decision making. As an underwriter, you are approached to provide credit for an obligor or buyer, but understandably, there is an element of due diligence that you would want to complete prior to issuing a policy. I'm aware that you can order a credit report in some countries, which will give you some financial background to the business and directors. And you may even take a bit of time to conduct some internet research yourself, looking for some impactful information that may help you make an informed decision as to whether you should provide credit. However, as we know from experience, conducting internet research yourself is an extremely time-consuming exercise. Finding one small lead in an internet search can then lead on to many others, which will all need to be followed up, leading to yet more inquiries to be completed, and so on and so forth. At Charles Taylor, we've started to set a new standard in how the industry conducts investigations, because there is no real standardized process or checklist that investigators use to conduct a due diligence inquiry such as this. For example, if I were to ask 10 people on the call to conduct a social media or open source sweep of the internet to try and establish some degree of intelligence that would help you with your decision-making process, we would all undoubtedly do it in a different way. And if we were very lucky, we might all come to the same conclusion. Our in-house technology solution reaches out to over 230 social media and open source data websites. And once that intelligence is gathered, we have analysts who will study the key elements and then produce a final report. Our analysts spend significant time looking for signs of an extravagant lifestyle, and we found some quite incredible results from recent inquiries about some very high-profile individuals and their businesses. Some of the key points that we look at when conducting a social media and open source investigation on a director or directors of a business were summarised by my colleague Roxy earlier in the webinar. You can certainly use social media and open source data as a good way to see who the CEO or CFO are associated with, and you can also see some of their personality traits. There has certainly been a close link, there's certainly been a close link between some of the questions posed earlier and businesses that have failed in recent years. It truly never ceases to amaze me how much information you can find out about an individual or company on the internet. Whether this is from an open source social media profile, some news articles, or as in one example, an online video filmed by an enthusiast about a subject's car collection. The sheer volume of information is astonishing. Quite recently, we were asked to produce social media and open source data report on the business activities of Dr. Bhavaguthi Shetty of NMC Health Limited. As I'm sure you can imagine, there was a significant amount of information about these subjects within the public domain and available to anyone with the time and resource to conduct these searches. I'm just now going to spend a little bit of time showing some of the extracts from our report, which are now up on the slides. So firstly, once we received the report, we noted that it was over 900 pages. So it was evident that we had located a significant amount of intelligence about this individual. Dr. Shetty certainly thrived on being in the public eye. Next slide, please. We managed to locate 135 different social media sites that had various degrees of intelligence about Dr. Shetty. You can see from our investigation report that the individual appears to be heavily involved in sponsoring famous sports events. Next slide, please. And the next slide, please. And we also established that Dr. Shetty was very generous as he gifted his own personal Rolls-Royce car to a famous musician. As we all know, a Rolls-Royce such as this is probably valued in the region of £200,000, if not more. And just going very quickly back to a point I raised earlier, we can have the next slide, please. We then located this car enthusiast YouTube video upload, which demonstrated the number of expensive cars Dr. Shetty owned. Unfortunately, I don't really have time at this present moment to show the exact video, but his car collection included a £1.7 million Mercedes limousine, amongst other extremely expensive cars. Again, this report just really goes to show the level of information we're able to obtain during these investigations. So that concludes my part of the webinar today. Back over to you, Robert.
Great, thanks so much, Simon. So our final presenter today is Ed Brittenham. So Ed is a consultant to Charles Taylor and is located in Connecticut. He has over 30 years experience in the insurance industry with deep expertise in all aspects of specialty insurance products, including trade credit, non-payment, political risk, and surety. Ed has a master's in economics, and he's worked in the US, Brussels, Paris, and London, and managing operations in Asia and Latin America. Thanks, Ed.
Thank you, Robert. So I want to just talk for a few minutes. Once a claim comes in, and if there may be some suspicions that something might not be totally correct about the claim, what should the claim handler do to look into that a little bit more deeply? And I think we advocate in that kind of circumstance a risk-based approach where the claim handler starts by doing just some simple checks from their desktop that are fairly straightforward and easy to do. And then if that doesn't satisfy or put aside the suspicions or the concerns, then dig deeper with some more elaborate checks. I think it's important to recognize in these cases that even if there really is a fraud going on, you may never really get to the bottom of exactly what transpired, and you shouldn't expect to uncover a smoking gun. Rather, I think it's a matter of just taking each case on its own, going step by step, and seeing where the facts and the information lead to. In terms of making an investigation of fraud on a claim transaction, I think there's kind of three steps. First, check out the counterparties. Second, check out the transaction documents for the claimed transaction. And finally, compare the two. It's almost a common sense approach to make sure that everything really seems plausible in the transaction that's being claimed. And Robert, next slide, please. So if we start with looking at the counterparties that are involved in the transaction, and by counterparties I mean the seller, the buyer, whoever else, the supplier, whoever else may be involved. But there are a number of very simple desktop checks that can be done. I very much like just using the Google Earth app to look up the company's address from a satellite perspective. And if you're expecting to see a factory or a warehouse near a port or something like that, and it turns out that it's the address is a suburban home near a city, well, that's obviously something that might provoke further concerns. And you can also tell quite a bit from looking at the company's website. Just about every company these days has a website. And in fact, if there isn't a website, that's already potentially an issue that may be of some concern. But check the level of detail and functionality on the website. Is it just some pretty photos and platitudes, or is there really some things there, detail about the product, some press releases, some functionality for customers and so forth? Usually a website will have a phone number. Why not call the number? See if anyone answers, and if so, who they represent themselves to be, and if you seem to be surprising them or not. And also there's an app called whoissearch.com, where it's very simple to look up the domain name of a website and see when and where it was registered and how. And I think that's quite a simple thing to do, in the sense that if the website was registered more recently than the transaction was supposed to have taken place, then that's obviously a potential red flag. And finally, in Europe, all companies have a VAT number, and that's usually shown on the company's documents as well as on their website. And there is an app that's easy to use on the web to validate that the displayed VAT number is in fact a valid VAT number. So these are very simple desktop checks that anyone can complete in just a few minutes to see about an individual counterparty. In the event that this doesn't really satisfy everyone's concerns, then it's maybe time for a deeper dive. Simon just went through what can be achieved by looking at the social media and discovery reports on the principles of these businesses. I think it's also interesting to cross-reference the subsidiaries, affiliates, and directors of the different counterparties involved in a transaction to see if there are any directors in common, if some of the addresses, are the same when they're really not supposed to be, issues like this. And finally, look at the financial performance of the counterparty and compare it to some other companies that are active in the same economic sector. If all these companies are active in the same sector, they should have broadly similar looking financial performance during a given period. And if they don't, if something really jumps out, then that might be a cause for concern. And so, Robert, maybe go on to the next slide. And the next stage of this is one before that. There you go. The next stage of this is really to look carefully at the transaction documents. Review the original purchase order, the sales contract, the shipping documents, the invoice. See if they're consistent amongst all these different documents, and take a look at the level of detail that's describing the goods, that's describing the delivery mechanisms, et cetera, et cetera. And does it look plausible and realistic, or could it potentially be something that someone just ginned up on their word processor? Do the payment terms that are specified on the transaction align with what's the normal industry practice for the goods that are involved? And then there's also, I think, a very important point is really comparing the size of the transaction and the product that's involved in the transaction with the size and activities of the various counterparties. If you have a counterparty that has an annual sales revenue of $5 million and suddenly there's a claim transaction of $20 million, then that's obviously an issue that might warrant further investigation. And finally, a lot of the shipping documents, and it's quite common that they're made out to order, the bills of lading can be made out to order or to bearer, giving physical title to the goods. And this is not necessarily in and of itself a suspicious thing, but at the same time, it does make it more difficult to verify that the counterparties were actually involved in a legitimate transaction. So if this kind of check of the transaction documents doesn't put the concerns to rest, then a deeper dive is absolutely possible. And you can look into whether if the goods were supposed to move on a ship, whether that ship actually moved between the ports that it was claimed to have moved on, and that the type and size of vessel was appropriate for the goods being transported. Take a look at the sales contract. Are the terms and conditions of the sales contract consistent with the customs and practices in that particular industry for the relevant type of goods? And also do a price check. You can look up for most commodities and for a variety of other products what the sort of typical market prices were at any given date in the past. Look up and see whether the prices that are shown on the documents are actually within plausible range of what the published market price was at the time. Finally, if you're dealing with a case involving traders or distributors who are just purchasing the goods and on-selling them rather than processing them themselves, you can always ask to see the transaction documents evidencing how that trader or distributor acquired the goods that they ultimately sold or claimed to have sold to the buyer. So those are ways that you can check the transaction documents. And Robert, if we could go on to the next slide here. Yeah, I'd just like to sort of sum up and conclude by a quick case study that we worked on recently involving receivables arising from several trades of palm oil. And as we looked through it, our client was concerned about the veracity of the claim and asked us to do a little bit of a deep dive on it. And as we looked through it, we found that the shipments did appear to be legitimate. The vessel did move the way that it was supposed to have moved in the bills of lading. There were appropriate vessels for the palm oil described. We did a price check, and that confirmed that the prices on the contract were within very small 2 or 3% of what the market prices were, and so seemed perfectly plausible. We looked at the sales contract, but here we came across some anomalies. And really, the sales contract, the terms and conditions of it, seemed like it was really designed to be a sales contract for a shipment of dry goods and not for liquid palm oil goods. And so this did really raise some suspicions on our side. And then finally, also, we looked at the counterparties involved and compared them to some of their peers in the industry, and found that a couple of them really had very implausible growth. They were sort of doubling their revenues every 2 or 3 years when the market was largely flat, and there wasn't any obvious indication of the value that they were adding or the competitive advantage that would explain that. And so that raised some further submissions. And then we also did do some look on the social media about the principles of these companies, but again, nothing was very remarkable about that, and so that seemed okay. So with that, having just gone over a case study describing reviewing these documents and transactions and counterparties, I'll turn it back over to Robert.
Thanks so much, Ed. That's great. So we're going to move on now finally to our second poll. And so I'll ask Jada to pull that up for us. And so the question is, a director who is potentially exhibiting poor corporate governance would A, spend company money to provide daycare for his staff's children, B, ensure the company has a diverse board where at least 50% of the directors are female, C, spend company money on an exclusive private jet for his own use, have a forward-looking ESG policy, or spend company money on excellent healthcare for staff? I don't think this is going to take people too long to get the right answer on this one, but we'll see. Okay, let's have a look at the results here, Jada. There we go, 97. That one was a little bit too easy, I think. Okay, thanks everybody for that. Great. So now we're on to the question and answer section. So I'll have all the presenters come and join me here and turn on your videos, and we'll go through some of the questions that we have here. Perfect. Thanks, everybody. So we have a question that was sent through to us earlier, and it's a little bit of a nested question. So I'll read it out in full, but if we need to break it down, we can do that. So the question is, large structural fraud cases are usually set up to defraud banks and possibly major creditors. Non-payment insurance is used to give support to financing. So how does the fraudulent intent become clear to an insurer? If an insurer has suspicions about the conduct of a business, has it a duty to advise financing institutions? And if a claim is declined and the insurer terminates the policy as a result of what is discovered, has the financing background for legal action against the insurer? And finally, does the Insurance Act of 2015 have any bearing? So I'll pass that one over to Ed.
Thanks, Robert. And I note this question came in from my former colleague, Glenn Sexton, and thanks for this question, which I think is very relevant to our discussion today. Obviously, this is a special case where banks are supporting trade credits where a customer of the bank is actually originating the receivables that are insured by the policy. And the difficulty arises if there's a suspicion that those receivables might be fraudulent. In other words, that they're fake invoices that have been financed and insured. How it plays out between the insurance company and the bank in those circumstances really depends on the contractual relationships between the bank and the insurance company. And there's three types of arrangements there that are commonly practiced. The first is that the bank is simply a loss payee under the policy, that any claims are adjusted with the insured and then paid to the bank. But the bank does not formally insure under the policy. A second scenario is that the bank is an additional or a joint insured with the originator of the receivables. And in some of those cases, depending on the drafting, the bank may have the right to step into the shoes of the insured in certain circumstances, typically such as paying the premium or something like that. And finally, the third scenario is where the bank is, in fact, the insured itself, and the originator of the receivables is not a party to the insurance policy. So the outcome of those types of cases really depends largely on the specific arrangement. And it can vary. And in some cases, the bank may not have an independent right to claim on the policy. And similarly, the insurer may not really have the right to invoke the fraud exclusion that applies to the fraud to the policy, even if they suspect that the underlying receivables are fraudulent. So it's really something that's more of a case-by-case situation. Generally speaking, though, I think it's important to recognize that banks may very well have exposure to performance risk on the originator, and that they really need to manage that risk appropriately and accordingly. Thanks, Robert and Glenn.
That's great. Thanks so much. So we do have one more question here, and I'm going to give this one to Simon. So regarding the photos of Dr. Shetty, the question was, I understand that they may be available on social media now after the scandals, but if we looked 2 years ago when everyone still thought NMC was a great company, would we have still seen them then?
Well, the thing is, Robert, all the information we find is in the public domain, so it's quite likely a lot of the information would have been there 2 years ago. So, anyone who technically has enough time to search the internet would be able to find similar information to what we have, but all I would say is they'd have to have a lot of time, probably 30 hours or so to do that. I'm not sure any of us would at that length of time how busy we all are.
So true, so true. So we don't have any more questions that have come in. I think it was a really interesting presentation from all of you. So thank you so much for that. Jada, if we could just move on to the CE credit slide here. So as we mentioned, the credits are here for adjusters, brokers, and examiners. If you send an email to the email address below, you will be able to get you those certificates for Alberta, Manitoba, or Ontario. If you're in other provinces of Canada and you just require a certificate that you attended rather than an actual certificate for each province, we can get those created for you as well. So thanks everybody again for your time. Really appreciate it. And we'll see you all again for our next webinar. Thanks.